Hello. Today I'm going to talk about accumulation and dollar cost averaging. In going through my daily messages and mail over the last week or so, I have come to the very strong conclusion that a lot of people really don't understand what a proper dollar cost averaging technique is, or the significance and real world risks of accumulation. So today I want to dedicate this video to specifically talking about those items and why they are so critically misunderstood. So let's start with the basic usage in the common market. You'll have blah blah business that says you can buy Bitcoin or Ethereum once a week and dollar cost averaging your holdings. When you do this over a year, you have 52 purchases of a asset with a average value of all of those purchases. There is a serious problem with that usage and definition. It's wrong. Proper dollar cost averaging is not reoccurring purchases. What that individual has done by purchasing some asset 52 times in 1 year is just reoccurring purchases. And whatever company is making interest on holding their money is quite happy with them. Real world dollar cost averaging is strictly about purchasing when the asset is below the average cost of what you are purchasing. You never purchase above the average, ever. If you purchase above the average, you raise the average, which means you won't ever be able to make a true profit from it. Profits come by purchasing below the average. And I'm going to demonstrate this with this chart and with Jackrabbit's statistical data that has been collected on the website. Now I'm using Link USDT off of KuCoin on the 15-second chart. This is a reasonably aggressive approach because it demonstrates accumulation and a proper dollar cost averaging very well. Now, the very first things that are often misunderstood with accumulation and a proper dollar cost averaging format is the risk. Now, accumulation and DCA are technically one in the same, but the DCA brings the point that you are explicitly purchasing for the intent to sell with profit. Accumulation is just a general term of constantly buying every so often that may or may not lead to a profit. So for the purposes of this demonstration, we are focusing on Jackrabbit with the Jackrabbit methodology of automated trading. And we are looking at a chart that shows 7 trade cycles. So 7 times this combination of strategies sold with an average of 1% profit. The average number of positions, or the average accumulation, is 5 positions. The worst case it has seen so far is 12 positions. These numbers are important because they describe exposure. How bad can things get? What is the worst case scenario? That is critical to understand in a proper dollar cost averaging approach. Your worst case scenario is your worst case loss. From the standpoint of Jackrabbit, we see on this chart that the average is 5 positions or an average exposure of $50 if your position size is $10. Your worst case scenario so far with this chart is $120. But when I set this chart up, I set it for a worst case scenario of 100 positions. So my absolute worst possible loss would be $1,000 for this asset. Thinking about your worst case scenario is critical in a proper accumulation approach, because it is very possible that you could accumulate 100 positions or $1,000 before you actually make a profit. There's no way to predict the market, and that's why accumulation is my preferred way of managing my risks. The intent of dollar cost averaging in this situation, and my intent behind my accumulations, is not to take a willing loss. That's not to say that I can't take a loss, because I can. Hard work can malfunction, the internet could break, and there's a possibility that I could miss a trade. And I could take a loss because of that. But through accumulation using the law of averages, that is mathematics, that over the course of 100 or 1,000 trades, a loss will be averaged out. You'll notice, for example, the average profit of 1.08%. And you'll see that my last profit was 1.1%. So the system tracks the last profit and the average profit. Again, the law of averages is a critical point in proper dollar cost averaging. So let's actually go look at a few completed trades within this recipe. Okay, let's see if we can find the last selling point. Okay, here is the last selling point. Now, we make a purchase here. The blue line is the average of our purchase. If we've only made one purchase, then the blue line is just the price by which we made that purchase. The green line is the take profit. Remember that our intent is to purchase with making a reasonable profit. In this case, the green line is always 1% above the blue line. That is the choice I made for my reasonable take profit. Okay, so now let's open this up a little. We made a couple of purchases here, and you see that the blue line dropped appropriately to each of the purchases. Our purchases were below the average, so our average price went down. That is critical. That is what we want. Because you see, at this area, price went above the average. You do not want to purchase above the average, because if you purchase above the average, it will raise the average price. So you will never be able to legitimately take a true profit. So, dollar cost averaging has a very clear rule. Only purchase below the average. And as you can see, a lot of space we didn't purchase. The market dropped and we stayed out of it. But then our trading strategy signaled more purchases. And subsequently, with each purchase, the average was brought down. And you can see the price took a horrific tumble again. It went down quite a bit. And it just kept going down and it went up. So the price actually went up here. But it's still below our average when we made the two purchases that this screen shows. That's the critical point. The price must be below the average to properly dollar cost average. And of course, price dropped again and again, went up a little, it dropped more, and it purchased here. Way below the average, but it still dropped the average. Each purchase brings the average down to the point that we are today, currently holding 12 positions. So we have $120 at risk right now with this current market situation, and we can see by this analysis that the price is 3% below our average. This is a nice little feature within Jackrabbit that helps you realize exactly where your price is in relation to your current average and take profit. So if we are 3% below average, then that means we are 4% away from a profit. So now let's go back and look at the last successful trade cycle, which would be right here. We sold at a profit. So let's go find where this trade cycle begins. Okay, here we go. This trade cycle begins right here. We make a purchase, price shoots up, but it doesn't touch our take profit line, and then it drops. Then we make another purchase, price goes above our average again, but again does not touch our take profit. And yet again it drops. It drops and we make another purchase, so we lower the average. Now, price climbs above the average and eventually climbs above our take profit, and we make real money. So this is a $30 position, or 1%, 3 cents. So we made 3 cents of money on this position for a $30 exposure. That doesn't sound like much, does it? But that is the real world method of using accumulation and trading properly. And it's really no different than a risk to reward ratio of 1 to 2, except that you're not taking losses deliberately. You are simply adding to your position and going from there. Now let's look at this particular trade cycle. This one is only one position. The entry point is, let's see if I can get this thing to cooperate. The entry point is right here. The blue line is our average, and we made a profit of 1 penny. So, 1 penny profit for a $10 exposure. Not glamorous, not award-winning, not earth-shattering. But that is the whole point of what makes accumulation so successful. It works by aggregation over time. For example, in looking at the chart, and you see the equity curve, you can see for the 22 trades that this process has taken, it's made a profit of $2. That doesn't sound like a lot, but the reality is this is running. This has only been for 5 days. So we have 30 days in a month. You've made $2 in 5 days. This approach would make $12 in 1 month with the current price action for one coin. Now, if you traded more than one coin that used this approach, well, then it could be 24, 36, so forth. Risk versus reward. And that is the whole intent and point of what makes accumulation so powerful. It's a different kind of risk, but it's one that over time can be considered consistent and profitable. You always know exactly how much you have at risk. You always know what your exposure to the market is and how bad things can get. That is critical for real-world risk analysis. This particular position has this trade cycle has 5 positions. So a $50 exposure, or 5 cents profit. So you figure $2 doesn't sound like a lot, but with the worst case scenario being $120 and the average being $50, it makes reasonable sense. It's a reasonable level of risk that helps protect what you are trading. But there are consequences. You should only use accumulation on an asset that you want to trade for at least 1 to 2 years. There is a possibility that if the market really drops, you could be holding for that long before the market recovers enough to sell at a profit. The second thing that you need to be aware of with a proper dollar cost averaging technique that has high levels of accumulation is that not every asset is worth purchasing. I recommend only assets above 1 billion market cap as a consideration. And as far as really trading larger assets, 2 billion is the favored for the market, where you are pretty much almost guaranteed a very strong probability of recovery. There is the case, like March 2020, that an asset could just death spiral right off the market. And that happened in March of 2020, where several large holdings were completely and fully liquidated. So this is not risk-free. It just gives you a better understanding of what your risks are with a worst-case scenario approach. Now we see the chart, but let's see some longer-term data and actually see exposure versus profit in a real-world analysis. So here we have it. The same coin I just showed you in the chart. Here is each purchase, when it was purchased, and the price it was purchased. And then you see the intent to sell with a profit. All of this accumulation is in fact the point and purpose of what this process did. It made each of these purchases at this price. When you are analyzing a strategy to determine if it's appropriate for you, don't buy the garbage on the internet when people say they can't give you their numbers. All they're telling you is that they're trying to steal your money. Real-world analysis is done with real-world mathematics. You can take all of these numbers, put them into a spreadsheet, and get reasonably close to this number within what I call a standard deviation, because the market always has a certain level of slippage where two people trading side by side the same exact asset will get slightly different prices because of their connection and exchange speeds. But that standard deviation is in fact mathematically calculated. You can take the course of hundreds of trades and figure out what your average slippage is. In my personal case, my average slippage is from minus 0.3% to plus 0.3%. And what that means is that the market could be 0.3% what TradingView shows when I actually make the purchase, or it can be 0.3% above my purchase price. And that applies to both buying and selling. So my actual purchase price could be lower than what TradingView says or slightly higher. But the average of my slippage will always be consistently zero between the combination of above and below the average slippage. So this is a reasonable way to figure out real world numbers as they would apply to you and your own personal financial situation. Now, as I said, this is an aggressive approach with this coin. Momentum, MACD, RSI, TCA is the combination I used. Clicking on this link will take you to the chart I just showed you. So let's look through these profits. As you can see, there are a lot of purchases. And those purchases are your exposure. Understanding exposure is critical to evaluating your risk within a dollar cost averaging approach. If you have 200 positions at $10 each, you have $2,000 between your assets. In this case, let's just take something simple. 50 positions at $10. My exposure is $500. My profit of $500 at 1% is going to be $5. That is how real world profits work with a proper dollar cost averaging technique. Now, as you can see, The first two cycles were quite lengthy, but now we're getting into some shorter cycles. For example, this cycle only had 2 purchases. This cycle had 4 purchases, 4 purchases, and 1 purchase. All of that affects my basic accumulation. That affects my exposure. It affects my risk. So by seeing this information, this is why I chose 100 as my worst case scenario. Because realistically, that is the most I want to risk on this asset. And finally, we see the last trade cycle, which is still in progress. And it's done nothing but purchase so far because the price has dropped significantly from our average and is still well below our average. Now let's look at the actual profit graph. This is where we see real profits versus real exposure. So here we go. We can see with this particular coin, my worst case exposure was roughly $165. So $165, 1% would have been $1.60 profit. But you see here, anything above 0 is when I completely sold off the asset and I took my profit. So let's zoom in on this. And you see my profits. They accumulate over time. And that's the important part to understand. Through the process of recycling your budget, you will accumulate profit over time. Let's see if I can get this zoomed in. Okay, here is the course of my entire trade history. You see here, I made about $1. Then it just kept going up slowly and consistently. That is how accumulation and proper dollar cost averaging work. You accumulate with the sole and explicit intent of selling with a profit. So next time you see people talking about buying on a market and to the moon, well, they're never going to go to the moon because they never sell. That's the problem that exists on the current market right now. People say, oh, I'm dollar cost averaging into it. That's all fine and well until you ask them when are they going to sell it. And they don't have a plan. They don't know when they're going to sell because they've never sold. They've never realized their profits. All they've done is made reoccurring purchases. Dollar cost averaging is about the explicit point and intent of selling, and selling with a profit. Let's get rid of this, and now let's go look at another chart. All of these charts have real world numbers that you can look at and apply to your trading. No gimmicks, no games, no lies, no manipulations. You can see exactly how the process works and be able to decide for yourself which approach is appropriate to your own personal situation. And every approach has its own risks, its own exposures, and its own profit basis. Some are aggressive, some are slow and defensive. You pick what works best for you and your personal financial situation. Okay, let's go with this strategy. Okay, my first purchase was on the September 20th, and I haven't made a purchase since. So this is a very slow process. Today is the 19th of October, and I have not made any purchases whatsoever. So this demonstrates a very conservative approach. Let's see if we can find something with a little more life to it. Okay, how about Ethereum? Now this is a bit of an aggressive approach as it has a lot of accumulation. That is the purpose of accumulation. You measure your aggression through the number of purchases. The more accumulation you make, the more aggressive the strategy is. The less accumulation, the more defensive the strategy is, because you evaluate your risk based upon the accumulated exposure. Here, this has a reasonably, not overtly high, but higher than what a lot of people might like. And as you can see, it does cause some extensive accumulation. But it also provides quite a bit of profitability and quite a few cycles that don't require large amounts of accumulation. But you still need to be aware, like right here, roughly 16 positions, worst case scenario so far. So this could easily go up to 40 positions in accumulation under the right market situations. And you see that each time it makes a sell, the profits go up. But when it purchases, it replenishes its position from its profits. In other words, it's constantly recycling its money. So you can actually calculate how long it would take consistently to get your worst case accumulation in the number of positions. If your position is $10, you're going to make 1 penny profit. So that tells you you need 100 successful trades to make $10. Again, you have the ability to mathematically see exactly every point of risk, every point of profit, and every point of exposure. Always check numbers appropriate to your own personal risk assessment. Never trust anyone who says that you could be manipulated if they show you their numbers. That's a sign they're lying about their numbers. Real strategies will show you what I am showing you on the screen. Real purchases, real sells. This one, for example, has done nothing but purchase since I brought it online. And I brought it online October 10th. Let's see what else we can find. Okay, here is another example. This coin is probably moderate in terms of exposure. It does have some exposure, it does have some accumulation, but it seems to present some very good opportunities of profit. But the last cycle has quite deep accumulations. As you can see on the zero balance graph. Right now, I only have a little more than $35 of accumulation at the current rate of purchase. But that is still something to consider if you have a $10 position size. That would be $350 of exposure. So these charts are based in such a way that you can see the numbers easily and apply them reasonably well to your own personal situation. Here is another simple chart that demonstrates a more defensive approach, but that approach has proven still quite profitable. Jackrabbit's dollar cost averaging is a very strategic, concise, and precise methodology for the sole intent of a consistent profit. That consistency is based upon the combination of its modules to give you either an aggressive or defensive recipe. But once you study how each chart looks, and you can copy the existing equations exactly as they are and get reasonably close to what these numbers should give you on the basis of a standard deviation. Now you'll see that I have multiple cases of the same coin being traded with different recipes. That's because there are different levels of risk for each recipe. Some recipes have higher risk. Some recipes have lower risk. There's different levels of take profits. In this case, 350, 2.6, 3.49. This particular strategy does extremely well for this particular coin. Will it continue to do well in the future? Maybe not. As you can see here, it entered a very deep and aggressive accumulation cycle. But it finally sold off at 1.25%. So this is where testing is required, and you need to really look at your own personal risks. If you just look at the strategy from this information, it's misleading because you don't actually see the truth of just how bad the market can get. This is a perfect recipe that normally does exceptionally well, but with the right market, it can accumulate a large number of positions. If you've done your planning properly, you will be rewarded with a profit at the end of the market accumulation. That is, the average finally reached the point that price shot up above it and it made a 1.25% profit. Reasonably speaking, the whole point of this process, the whole point of Jackrabbit's DCA approach is to average into a profit. But it works based upon worst case scenario planning, proper budgeting, and understanding your real world situations. And as you can see, I actually didn't put very much into this coin. But if I put $10 per position, I would be at maximum exposure of $5 or $50, excuse me. So when you look at this chart and you see the purchases, it's easy to figure out your exposure. Count the positions, multiply it by your position size. That is your exposure. That is the worst case situation that you can lose if the market really goes against you, or if it liquidates like assets did March of 2020. This particular asset is not a very strong asset. So it's one I do not recommend trading unless you understand the risks. Now let's look at another particular combination. Same coin, different recipe. And you see it starts out with a very high accumulation level, but it sells off with a 1% take profit. And then you see more accumulations, more take profits. Reasonably well in here. If my profit is 1%, and that's all I'm willing to accept, why am I only getting 99%? Or excuse me, why am I only getting 0.99% profit? This is the perfect example of how slippage can rob you of profit when it goes against you. And this is why you need to focus on averages and not absolutes. And here you see the actual profits graph. Now, because this coin is not all that great in terms of its market cap, you can see I balanced my exposure appropriate to that market cap. I didn't put very much money into the analysis at all, just because it's not something I would trust with a lot of money. But it's enough that I can take this information and I can multiply it by a position size, and I can get a factor that I can rely on, and then I can calculate my profits based upon that factor. That really is the whole point of this analysis. That's the whole point of what Jackrabbit shows you. Real world case situations that you can reliably and consistently anticipate, where you can test the numbers, you can see the numbers, and you can evaluate in real situations how a given strategy will benefit you personally. Now, hopefully I've covered all of the points and differences of real accumulation versus the nonsense being preached on the market. Real accumulation is about real money, real intent to sell, real profits. The nonsense preached about buying once a week and without the intent of selling, all they are doing is making money on you through interest, but not letting you make money on your own money. When you accumulate, when you dollar cost average, do so in a way that you profit. Of course, feel free to visit the website, look at the various statistics I have created, and evaluate the market appropriately with real numbers. Don't fall for the scams and gimmicks on the market where people won't show you real numbers, real trades. If they aren't willing to show you real trades, they're simply trying to steal your money. Twitter is filled with influencers who say that their strategies are so great, if they show you their numbers and their trades, you would be manipulated. Hogwash, nonsense, garbage. Those are the kind of people you should report for fraud, because they are stealing people's money. Real numbers tell real stories. You can see real profit and real loss with real numbers, and that's exactly what they are afraid to show. They make their money by pawning off their garbage to innocent people and stealing people's money through their fraud. When you evaluate a strategy, ask for the real numbers, real proof that what you are interested in is successful. Don't fall for the scams or the influencers or the rhetoric. Test and evaluate. Take your time. There is no such thing as fear of missing out. The market will always have opportunities appropriate to your personal situation. It's just a matter of understanding your situation and what your risks really can afford. If you have any questions, let me know. Leave them in the comments section below. Join the support server. You can leave them there. Look at these charts. Look at this information. Evaluate accumulation the way it's meant to be evaluated. It's not the best thing on the planet. It's not the worst thing on the planet. It is a method and technique of mitigating risks with real-world consequences to those risks. Those consequences are your exposure. Until next time.